Good afternoon and welcome to the 28th Annual Market Outlook hosted by Bender Commercial. I'm one of 8 partners here, Michael Bender, and we're very pleased that you're here. We're honored that you're here. We've done a lot of research and we're going to make a lot of predictions, so you're going to be uh, inundated with a lot of graphs and data. So sit back in your chair, go ahead and strap on a seatbelt because it's going to come at you pretty fast. And with that, it's my opportunity to introduce and bring up to the stage Reggie Kuipers, the president of Bender Commercial, and he's going to kick off the presentation. Reggie?
All right.
We're good.
All right. Well, thank you, Michael. Well, good afternoon to all of you. Thank you all for being here today. It's truly an honor for our team to host you. 28 years of the market outlook. 28 years ago, Michael Bender started Bender Commercial Real Estate, and 28 years ago, he had his first market outlook. The first market outlook was about 6 to 8 people around a lunch table, and it's grown immensely. But the purpose has never changed. It's our goal. Our why is to give you timely, trusted, and accurate information as it pertains to the commercial real estate sector so you can go and make educated decisions in the next 12 months. My presentation today will focus on national macro view. We'll take a deep dive into the Sioux Falls micro view, and then I'll save some predictions for the end. Right? A year ago, I stood on this stage and we were staring down the barrel of what I thought was going to be a very tumultuous year. It was an election year. AI was in its infancy. The Fed had not dropped rates yet. There was geopolitical issues everywhere. And that may have just been the appetizer for 2025. Okay? We're calling 2025 the year of the 5 T's. Trump, tariffs, taxes, T-bills, and you add those all together, and you're going to get a little turbulence, especially in an already robust economy. Now, Trump's policies, most of them are going to put upward pressure on inflation. Think about it. Okay, tariffs, upward pressure. Favorable tax legislation, that's coming most likely pretty soon. Upward pressure on inflation. Deportation, okay, removing a workforce from an already incredibly tight labor market. Upward pressure on inflation. Deregulation, less red tape. Can I get a hallelujah, amen, on that one? Again, upward pressure on inflation. All of those together lead to some widespread uncertainty, okay? We're going to start this year looking at jobs, as we do every year. Jobs drive the economy, okay? We feel really good about our jobs. We go spend money, and we continue the flywheel. The United States number last year finished at 4.1%. Comparatively, Sioux Falls, we generally track right at 50% of that number. No different this year, 1.9%. Incredibly robust labor market. Let's take a look at GDP. 2024 finished the year at 2.8%. How does that compare to other recent years? 2022 was 1.8%. 2023 was 2.5%. And 2024 was 2.8%. It feels like the economy is building momentum. It's actually accelerating a very healthy underlying economy. Now, because of some of the uncertainties that are coming, most of the top economists believe that the GDP this year will fall back into that 2 to 2.2% range. Let's take a look at inflation. This is a CPI chart, year over year, December reading. Okay, we finished the year at 2.9%. Now, coming out of the pandemic, the Fed's printed a lot of money. Nick is going to talk about that in just a few minutes. We loaded our pockets with cash. We spent like crazy. We raised inflation to 9.1% in June of 2022. The Fed took out their sledgehammer, raised rates from 0 to 525 basis points, and we drew back. The economy responded. But we've kind of flatlined around 3%. Okay? The Fed's stated goal is 2%. How do we get that last mile of inflation down? I'll take a look at that in just a couple slides. But first, I want to talk about the Fed and their probability of a rate cut. We'd all like to see some of that. Well, we just had a January reading. The CPI number was 3%. Okay? It's a hot reading. That the Fed meets 7 more times this year, And that all but killed, the next meeting is in March, it all but killed an opportunity for a rate cut. When do we think there may be a rate cut? And this is from the CME Fed Watch Group, Chicago Mercantile Exchange, people much smarter than me weighing in on this. Rate cut could come as soon as July, a 50% chance. Is there a probability of a second rate cut? Maybe. 40% chance of a second rate cut by the end of the year. What do I think is going to happen? I'll save my prediction for the very end. Let's talk about last mile inflation. Again, that Fed goal, stated goal is 2%. Okay, we're kind of stuck in neutral at 3%. How do we get there without the Fed raising rates, which I don't think they're going to do this year? I don't know that we're going to. I think 3% is the new normal for the short term, for the next 12 to 24 months. Okay, let's talk about deficit spending for a minute. The annual federal government budget, our expense budget, $7 trillion. Okay, we bring in about $5 trillion. It's a $2 trillion annual deficit. There's a $36 trillion total deficit. That's $110,000 for every one of us in here. We are way over our skis in debt. Enter Doge, the Department of Governmental Efficiency, Elon Musk. Now, I think Doge is mostly picking up crumbs and headlines, but they've exposed a bigger problem: wasteful, unaccounted for, unchecked government spending. And something needs to be done. There's a key date coming up, March 14th. The federal government is funded through March 14th. And the feds have done nothing, Congress has done nothing, especially in the last 5 years, but punt some of these hard decisions. And they add these extensions with pork. And it's time for us to probably hold them all accountable. And it's time for some action to reduce this deficit spending. Okay? And Nick's going to do a deeper dive on some of the deficit spending. But let's take a look at a visual. What does $1 trillion look like? Well, I want you to picture us walking into Costco. Costco in town's 140,000 square feet. It's 30 foot tall. If we stuffed that Costco loaded with $100 bills, we'd have about $6 trillion. 6 Costcos, 1 million square feet, filled with $100 bills. I don't know about you guys. Seems like too many free samples to me. All right, let's talk about tariffs. This is a map of the United States and the biggest trade partner. As you can see, South Dakota's biggest trade partner is Canada. About a month ago, Trump proposed to implement 25% tariffs on both Canada and Mexico. Within 24 hours, he had the Prime Minister of Canada and the President of Mexico at the negotiating table. Why did they respond so soon and so fast? Well, 75% of Canada's exports are coming into the United States. 77% of Mexico's imports are coming in to the United States. A 25% tariff would put immediate recessionary pressure on both of their economies. Contrast that to China, where we take in 15% of China's exports. An additional 10% tariff on China has a much less impact on the Chinese economy comparatively. Now, that key deadline is March 4th, okay, next week. That 30-day extension that they negotiated with Canada and Mexico, this is going to play out right in front of our eyes here in the next couple of weeks. But if they're implemented as proposed, what's going to happen? Okay? Most economists believe that the CPI will run from 3% today to about 3.5%. Additionally, the 10-year Treasury could run from 25 to 50 basis points higher than it is today. It's currently at about 4.45 to 4.5%. Additionally, we'll have immediate impact on construction costs. Most economists believe that construction costs are going to go up by about 7 to 8%. Well, why is that? 25% of all the lumber that we use in the United States comes out of Canada. Okay? 14% of all the copper mined in Canada comes in to the United States. 17% of the steel comes from Canada, 13% comes from Mexico, and 24% of the cement mix we use comes out of Canada. Massive implications for construction costs if these are implemented as proposed. Again, just some uncertainties. All right, we're going to transition now. Take a look at Sioux Falls. As we started with the national data, we're going to look at the Sioux Falls jobs and population growth. The city of Sioux Falls grew by 5,700 people last year, about a 2.6% increase, which brought us to about 220,000 people. Now, if we look at the MSA, we believe that was probably closer to about 7,000 last year. And if we include the 5-county MSA, we are now at about 315,000 people. It seems to be accelerating the growth, which is great news. We did have a slight drawback, about 1.5% job growth last year, probably just a minor blip. We know that the underlying economy in our local job market is very strong. After people move here, they tend to look for housing. So we're going to take a look at the residential market here quickly. Okay. Comparatively, 23 to 24, slight tailwind, a little modest tailwind behind the residential sector. 5% increase in the amount of transactions. This is the total transactions in Minnehaha and Lincoln County. Okay, 5% increase in the amount of transactions and 20% increase in the total amount of those mortgages, of the volume of that debt. We expect to see a very similar year in 2025, a warm breeze behind the residential sector. Now let's take a look at building permits. Okay, this year you'll notice we added the metro area, Harrisburg, Hartford, T, and Brandon. We added them up cumulatively against Sioux Falls building permits. An interesting trend emerged. 5 years ago, that total was about 30% of the Sioux Falls total. In the last 2 years, it was about 40% of the Sioux Falls total. We actually believe that that trend is going to continue while the outlying communities continue to grow. Let's take a look now at the commercial sector. Okay? We look at this chart every year. We want to compare how does new construction compare to addition and remodel. If new construction outpaces, it's a sign of an expanding economy. And clearly, last year, by a factor of 3 to 1, new construction outpaced addition, remodel. Now, multifamily is included in that new construction number. If we take that out, it's still by a factor of 2 to 1. Very healthy local economy. How do we compare within the region? Okay, you'll notice this year we added the Sioux Falls Metro. Okay, combining those outlying communities and their building permits, we pushed us over 1.25 billion and about 5,000 per capita. We're kind of right in the middle in our comparative cities here. A couple of notes: Des Moines and Rochester had awesome years. And contrast that with Lincoln and Rapid City, had a slight pullback. Okay, Rapid City, a note there, they had 20 to 25% pullback on their construction number. Most of that was probably because they were overbuilt in the multifamily sector, which Alex Soundy will talk on here in just a few minutes. We've got several clients that are active in that market. We know it's a very robust economy, and we'll continue to monitor the Rapid City market. Okay, taxes and insurance. Feel the pain here. Anybody else with me? We're going to talk about insurance first. Okay. Last year we had a chart up here, the average insurance policy, and these are the two biggest expenses that hit on everybody's expense report. Last year we reported that it was about a 50% increase over the last 5 years, and several properties we've seen 20-30% non-renewals. The insurance companies are essentially getting out of the wind hail business or the roofing business, and they're making you self-insure. And it's going to be continuously painful, and these are hitting the bottom line. Contrast that with taxes. Anybody get a love note from the county last week saying that their property is going to be assessed for more than it was the previous year? Yeah, we did, and it's going to continue to feel the pain. I think there's justification this year for the first time in many years. I wouldn't be surprised if there's a line at the equalization office in a couple weeks when it's time to protest, because there's justification to do it this year. All right, some predictions. 10-year T-bill. I think we're going to hold out in the mid-4s for most of the year. Unfortunately, I actually believe we're closer to seeing a 5 than we are a 3. Inflation, 3% is the new normal, at least for the next 24 months. The Fed, I believe the Fed it'll be a stagnant year at the Fed. They will not change rates, just with all the underlying pressure, upward pressure on inflation. Despite some headwinds and some choppy waters and some turbulence out there, I do predict that Sioux Falls will have the second best year ever, totaling above 1.2 in building permits. And I believe that'll be about 1.4 billion in the metro area. That concludes my presentation. I'd now like to bring up Nick Gustafson to present on the capital markets. Thank you.
Thank you, Reggie. In this portion of the presentation, we focus on capital markets in relationship to real estate investing. Now, our clients have a lot of options when it comes to allocating capital. They can invest in equities, cryptocurrencies, commodities, and yes, even first growth Bordeaux futures. However, it's worth pointing out that the total value of the world's real estate equates to a 51% storehold of the world's wealth. Real estate belongs in every investor's portfolio. We are not central bankers up here on stage. However, we do spend a lot of time and effort trying to understand the markets that we're advising clients in. And here are several themes that we are paying close attention to this calendar year. And the first up is the M2 money supply expansion and its relationship to inflation, the cost of debt leading to lower investment sales volume, U.S. debt expansion. There's some scary slides on there, and we're going to talk about that a little bit. And then assets to hold in a debt crisis. So first up is the M2 money supply. What is the M2 money supply? Well, it's a measurement of liquid cash in the economy. So that's the cash in your pocket today, checking accounts, savings accounts, and CDs. This graph goes all the way back to 1960. And what I want to direct your attention to is the COVID-19 bar. As a country, to combat uncertainty during the pandemic, we decided to expand our money supply by 40%. That had some consequences. You've seen this slide before in Reggie's presentation. You read about it all the time in financial publications, and you feel it in the grocery store, okay? So basically, after our 40% money supply expansion, inflation went up to nearly 10% after really trending around 2% for about a decade. Let's take it a step further. What is this? This is the consumer dollar purchasing power, and there's two takeaways from this slide. Over the last 10 years, the dollar has lost 30% of its purchasing power. In the last 5 years, we've lost 20% of our purchasing power. Inflation is a silent tax on all of us. Let's talk a little bit about the cost of debt. And to start that off, we're going to talk about the 10-year Treasury. And this was the 10-year Treasury yield last year. And you can see it was somewhat volatile with about a 100 basis point spread up and down. And what is the 10-year Treasury? Well, usually it is regarded as the safest investment on planet Earth, meaning a risk-free yield. Next up, let's take a look at the bank prime loan rate. What is this? This is the rate that banks charge their good and best customers. The takeaway here is if you take a look back over the last 25 years, last summer, interest rates were at their most expensive since the dot-com crash. In other words, money was at its most expensive in the last 25 years, and that had some consequences in terms of sales volumes. We're going to start with global sales volume, and this is measured in dollars going back over a decade. And this is all the investment properties that sold in a calendar year. And the gold bar is the 10-year average. We had some really good transaction years globally. And then there was a pullback in 2020. Everyone remember their real estate deals being paused for about a quarter, maybe 3 or 4 months during COVID-19? Then with the flood of liquidity and low interest rates, we had our best years on record in 21-22. And then as central banks raised interest rates to combat inflation, we had years that were significantly under the 10-year average. Let's take a look at this on a national level. This graph goes all the way back to 2007, and I remember it was really fun being a real estate broker in 2007. In 2009, not so much. But again, it's the same trend line. Really solid, a decade of solid years in transactions nationally, a pullback during COVID in 2020, record years in 21, 22, and then really, some subpar years over the last 2 years nationally under the 18-year average that you see on this graph. Let's take a quick look at cap rates versus the 10-year treasury. Again, remember the 10-year treasury is considered a safe yield, a safe return. This golden bar shows cap rates going back all the way to 2009 in relationship to the 10-year treasury yield. This cap rate is showing all asset classes across the entire United States. And it's interesting, you can kind of see the spread or the delta that real estate investors are demanding over the 10-year treasury on this historical graph. Next up is US commercial real estate prices right here in the US. And this is a year-over-year measurement according to the St. Louis Fed. The two things I want to draw your attention to are the increase in prices in 21 and 22, and then some years of a decline in pricing in 23 and 24 as interest rates went up. Bringing it home to Sioux Falls, this shows U.S. investment sales volume compared to multifamily, office, industrial, and retail. And you're going to hear more about these asset classes as these presenters give their presentations. It's worth noting in 24, investment sales transactions in Sioux Falls really turned the corner along with the nation, up 7% nationally. And you can see in industrial and retail, those numbers were up huge last year. That's good news for Sioux Falls. Okay, let's talk about the US debt a little bit. These are kind of depressing slides, but we're going to get through them together. This shows the total US federal debt going back to 1970. And what I want to show you, or bring your attention to the two things, is the Great Recession. Everyone remember the Great Recession? And then COVID-19. It was really a linear expansion of our debt and then an exponential expansion of US debt. Let's take one step further at this. This shows US debt securities issued. Remember, we were talking about the 10-year treasury? So this is short-term debt, long-term debt, midterm debt. This is everything that the US has issued since 1970. 3 major inflection points. Everyone remember when we had a balanced budget in the late 90s? That was fun, right? Linear expansion through the Great Recession to COVID. It is kind of alarming when you take a look at the exponential expansion of US debt securities since COVID-19. We went from almost $600 billion to nearly $2 trillion. That is a massive expansion. Remember, when the United States sells a bond, there has to be a buyer out there in the world market for the bond. We are issuing a lot of bonds. These next 2 slides are going to be research that's been based on some of Ray Dalio's books. Ray Dalio is a legendary investor, founded one of the largest hedge funds in the world, and he did a study on the last 8 or 9 great global empires that had a reserve currency. And what he surmised from his research, there's basically 3 types of monetary systems in human history. There's hard money system. That's where I'm giving silver coins for a product or a good. Claims on hard money like banknotes. And in type 3, you have fiat money. What is fiat money? That's money that's not really based on anything. It's made up. The US has had a fiat money system since 1971 when we moved off the gold standard. The point I want to make on this slide is all of these great cultures, all these great empires failed or had a reset at some point. And when things reset from fiat currency to hard money, you do not want to be holding debt instruments or bonds. You want to be holding hard assets. What is a hard asset? Gold, silver, land, real estate. Those are the types of things that you want to earn or hold during that period. Second, the Ray Dalio slide, rise and fall of major empires. There's three parts of a great empire. The first off is strong leadership, strong culture, strong education, strong markets and financial centers. The top, where the empire becomes less productive, they start overextending, they start losing competitiveness, and at the last part, the decline, is when the empire starts accumulating large debts and they start printing money. And usually there's a civil war or revolution. Really, really depressing stuff. Do I think the United States is heading to civil war? No, I don't think we're anywhere close to that. However, what's depressing or concerning is when you take a look at our large debts and the printing of money that we're doing right now, those are concerning trends. We'll take this one step further. Has anyone out there heard of Ferguson's Law? Ferguson's Law is when a great empire begins spending more money on interest payments than the empire spends on defense, is the first warning sign that the empire is in decline. We went over that ratio last year. Somewhat concerning. This is a trend that is not a trend. I thought a year ago we'd be talking a lot about debt tranches or loan maturities. It looked like in spring of 24, there was a lot of financial publications talking about this looming wall of debt maturities that were happening. And there was a concern that there was going to be a lot of bankruptcies. That ended up not happening. In fact, it looks like most of those loans were refinanced, extended, or the properties that they were based on were sold. On this graph, the light looks green for real estate investing and real estate debt. So just a note here. Let's bring it home to Sioux Falls, and we're going to take a look at some local cap rates. And it's worth mentioning, what is a cap rate? You hear this in real estate investing all the time. A cap rate stands for a capitalization rate, which stands for net operating income that's generated by a property divided by a potential or an actual purchase price. In other words, it's the yield on a property. Let's take a look at just a handful of examples. First up is a southeastern office cap rate, $1.5 million transaction, new construction, 7.3% cap rate. PetSmart, think Dolly Farm, East Side Target. This sold last year at $4.8 million or a 6.36% cap rate. Nice transaction here, industrial transaction. This was sale leaseback. This was in the news. $33 million or a 7.18% cap rate. And our last example here is an industrial cap rate in T, South Dakota, $2 million transaction, 7.38% cap rate. One quick note, there's a lot of properties here and a lot of them are very different from each other. It just shows you the wild diversity we have even here in Sioux Falls in asset classes in commercial real estate investing. Alex will spend some more time talking about multifamily. It's time to make some predictions. I predict, based on all the inputs that I'm seeing, that inflation is going to run hot this year. We're going to be over 3% all year, and it's somewhat, I'm cheating a little bit. I'm taking a look at some of the short-term treasuries that need to be reissued or refinanced, and we're going to see a lot of debt issuance, and we're going to see a lot of PPP rising on the regional level, and this is all pointing to inflation running above 3% all year. And based on some of those inputs that we're taking a look at, there's a 0% chance that interest rates drop, in my humble opinion, this year. In fact, if we keep getting hot inflation readings, there may be a chance that interest rates are going up. I believe exponential treasury issuance will continue this year despite what the current administration wants to see. So in other words, the Fed is not coming to save you this year. Locally, I can say this with firsthand experience, local investors are well capitalized and they're holding a lot of cash. If there's any sort of distress or a deal available, there are a line of investors waiting to take advantage of a great investment property right now. We're not going to see widespread distress happen in our market based on what I'm seeing. Sellers are getting used to a new normal. I had a transaction in the last couple of months where the seller had a 2021 price point in their head, and they really wanted to sell the asset at that price point. However, after 9 offers came in at the new market number, they capitulated and sold. And after a 30-year hold, they did really well on that investment property. Sellers are starting to get used to new valuation numbers. I believe cap rates will remain steady, if not coming up just a little bit. And with that, I'd like to bring Braden up to talk about the land market. Thank you.
Brayden, could you please switch to the handheld for me?
Certainly. All right, well, thank you, Nick. As Nick said, my name is Braden Isis, and I'll be presenting on the land market here in our Sioux Falls Metro. Let's get started. We'll first start off talking about the unimproved land transactions, which by definition is just large tracts of land purchased for the purposes of development, typically on the outskirts of our cities. Let's take a look at the data. In this graph, it represents the number of acres sold each year. As you can see, we had our run up in 21 coming out of the pandemic, and we settled in at about 1,000 acres in 21 and 22. And I predicted we'd kind of stay on that trend in 24, but we came up short. We had about 770 acres. Let's take a look at some pricing. Overall, we had about 9 transactions, ranging from 21,000 an acre all the way up to 57,000 an acre, really depending on the availability of infrastructure, location, and intended uses. But what I want to draw your attention to is several transactions at the bottom of our screen. And that is in our Harrisburg and the City of T communities. Now, if you were with me last year, I presented on a trend that I started seeing emerge, and that is the migration of acres being purchased outside of the city of Sioux Falls. So let's revisit that conversation. As a recap, this is the graph I showed last year. And as you can see, historically, we were about 80% of the acres coming out of Sioux Falls. And in 23, that dropped down to 65%. And I actually predicted that this number would flip, that there would be less acres in Sioux Falls. So let's see where it ended up. Came in at 50%. Now, I don't know about you guys. I don't think ties are all that fun. So let's take the rounding out and see what happened. So just barely, my prediction came true. But why is this happening? What's going on? Well, there's a lot of factors, but the main one, I believe, is that in the city of Sioux Falls, there's only so many acres available with the necessary infrastructure. Of those acres, they have to line up with motivated sellers. And I think that's where the disconnect is and where there's a lack of opportunity in Sioux Falls. So developers are going to our neighboring communities and finding opportunity there. So what's that doing to the Sioux Falls development? Let's take a look. These numbers come from the Sioux Falls Planning Office. And what they do is they track what developers are getting ready, or what they're starting to come to the Sioux Falls Planning Office to begin the process of getting those acres approved for development. As you can see, we had a run up in 21 and 22, came down in 23, and we had a 10-year low in 24. Now, I don't think this is a cause concern because you can see the ebb and flow, but it is something to pay attention to, and it is something that I think the city of Sioux Falls is reacting to offer more opportunities for development. Here's a few that I've noticed. Number one, this is a Sioux Falls tier map. I introduced this last year, and what this is it allows the city of Sioux Falls to communicate to the public what acres are available for development in the next few years in Tier 1, the next 10 to 15 years in Tier 2, and the next 25 years in Tier 3. And as you can imagine, predicting 25 years out is not a perfect science. It's more of a best guesstimate. So what the city has done is it created a process that allows developers and their engineers to find pockets of land in the Tier 2 and Tier 3 that they believe all the infrastructure is there, so that they should be able to be developed sooner rather than later. And they can go to the city and get a request that those be moved. Now that process started in 23. And there was, the first year, there's about 44 acres that were moved. In 24, last year, we had 214 acres moved down to the Tier 1 from Tier 2 and Tier 3. And already at the tail end of February, there's 205 acres being moved or going through that process of being moved down to Tier 1. That allows some flexibility on the city's side and those acres to be developed sooner rather than later. Number 2, looking inward. The city of Sioux Falls created a new zoning ordinance, Midtown Mixed-Use Zoning. And this is for the main corridors, think Minnesota Avenue, think 12th Street. And this allows developers to develop sites with more density so that it allows Sioux Falls to grow vertically versus always depending on growing outwardly. And lastly, continued investment into infrastructure. The city of Sioux Falls funded a west side trunk line out by Cherry Lake that into the future is going to open up development for about 3,000 acres. Let's move on to improved land. As defined, you take those large tracts of land, break them down into smaller lots, add the utilities and infrastructure and street networks, and you sell them on a per square foot basis. Let's take a look at the data. We trended down in 2024, but overall we still had a solid year. We had a total of 69 transactions, resulting in about $73.5 million in sales volume. Let's look at the different asset classes. Office and multifamily were up in transactions from the previous year. Retail continues to be a solid performer in our market, 32 transactions. On the other hand, industrial was down. We only had 18 transactions last year. And if you were with me the last couple of years, I presented that I really still think it's due to the lack of supply versus the lack of demand. The demand is still there, but we've absorbed a lot of our industrial ground and haven't supplied it back, keeping our pricing high and our transactions low. So let's take a look at pricing. Overall, across all asset classes, our average is trending upward. But what I noticed and what I thought interesting was that spread between the lows and the highs this past year. And I think it really highlights that land is not just that simple of buying a piece of land. There's a lot under the hood that impacts that pricing. So what's to come? What's next for improved land? Well, we're at the tail end of 25 years, our first quarter of our century. And it gives us an opportunity to look at what the next 25 years is going to look like. And that's what several of our communities are doing. And as you can imagine, 25 more years of growth, we truly are going to be a metro area where one city ends and the next one begins. And it's encouraging to hear that several of our communities are looking at that and working together in their 2050 plans to create a cohesive metro. I'm encouraged and excited to see the plans come out later this year and how businesses are going to react to those plans and how that influences their decisions on where they're going to set up shop. So let's take a look at my predictions. For unimproved land, I believe we're going to come in about 800 acres this next year, staying on that trend that most of those acres are going to be purchased in our neighboring communities. Retail land and office land are going to continue to be strong performers into 2025. Industrial land, I have the transactions up. I think there's some supply being added this year that's going to get absorbed quickly, but it's going to keep our transactions up. And lastly, multifamily I have down. There's some indicators that Alex is going to discuss more in his presentation that leads me to believe there'll be less land transactions in the multifamily. That concludes my portion of the land presentation, but before we move on to retail, there is a national trend that we're seeing that we want to present on that is impacting us here locally. And because he's the most tech-savvy kid, farm kid from Toronto, South Dakota, I'm happy to bring up Rob Kurtenbach to discuss the digital gold age of data center land.
Thanks, Braden. Welcome to the Handheld Mic Club. This is the Cool Kid Club, so congratulations. Well, as Braden mentioned, we want to talk a little bit about data center land. That's a trend that's starting to make its way towards our market. And I've been fortunate enough to be involved in a couple of these transactions over the last 6 months or so. And this trend has been, this kind of been a hot topic nationally, and it's starting to make its way into our market. So let's start out by kind of figuring out what is a data center. So a data center today is really, put it simply, it's a place that houses digital data, right? We all have phones with photos and files and an iCloud account and a Google Drive and all that kind of stuff. That's everything that's in the cloud, which is ultimately stored at a within a data center. Well, with the recent boom of AI technology, there's kind of a new wave of data centers that are much more robust that's happening, and that's created a really big a demand for additional land to build more robust data centers on. And the people that are driving this are often referred to as hyperscalers. So think about, Google, Microsoft, Amazon, Facebook, or other users that are in that AI space. So let's talk about, what does a data center need? How does that impact us, here from a real estate standpoint? So they need fiber internet. They got to transmit a lot of data very, very quickly. They also need water. They need to keep their servers cool. They build these huge facilities that's just stacked with servers, and they got to keep them all really cool. And it's kind of a side note, they also have started to realize the benefits of our community or our area of the country because of cooler climate. It's beautiful out today, not so much about a week ago, but they have started to enjoy our climate from a cooling standpoint. And lastly, but most importantly, they need power, lots and lots and lots of power. So to put this into terms that we can all kind of understand, 1 megawatt of power generally is thought to be enough power for about 1,000 single-family homes. So for Sioux Falls, we have 56,000 single-family homes. So I'm not counting apartments, I'm not counting commercial or office buildings, just 56,000 single-family homes. So it would take about 50 megawatts to generally power those homes. Well, these data center groups are looking for a minimum of 50 megawatts all the way up to 300 or more megawatts of power. Massive, massive amounts of power. And where does this power exist? Well, often it's in these rural communities. And for you and I, if we're driving through an area and we see a farm field or a pasture, we just think of it as that, and there's these massive power lines running through it, but that could be the perfect site for a future data center location. And why is there so much power there? Well, partially it's because of alternative energy sources. So wind, solar, gas power plants, that's all that power is in those rural communities. It's typically in more remote areas. So that demand is going to create what we're calling the digital gold rush. So these smaller markets, they're going to have a pretty big economic impact coming their way in the very near future. And we're not talking millions of dollars, we're talking billions. So these data center groups, most of them are looking at structures of buildings that will cost about $1 billion to build, and they're going to spend another $2 to $3 billion in infrastructure and different equipment to outfit these buildings. So this is going to be a major impact on these rural communities. It's just hard to get your head around what kind of impact it could have in these rural communities. And for all of us, we know that the city of Sioux Falls typically has about $1 billion a year in activity. So imagine taking the last several years of activity and dropping it out in the middle of a small community. It's going to be a fascinating trend to watch. Well, land sale prices, right? How does it impact us? So nationally, well, first off, I'll say that most of these users are looking for about 200 to 300 acres. That's what they like. That's about the perfect size for them. So nationally, we're seeing that price average anywhere from $130,000 an acre all the way up to $400,000 an acre. Massive, massive transactions. Microsoft recently bought 124 acres in Northern Virginia, which is kind of considered the data center hub. They bought that for $3.75 million per acre. So for you math whizzes out there, yes, that does equate to $465 million of a land transaction. Pretty crazy. Locally, we're not seeing those prices, so don't get too excited quite yet. But we are seeing prices in around the $75,000 to $100,000 per acre for a land transaction. Again, 200 to 300 acres. Still very good pricing, considering our ag prices are typically in rural communities in that $10,000 to $15,000 an acre. This is going to be a really interesting trend to watch. We will keep you guys all posted. And if you have some family land in rural America, we'd love to help you out. So give us a call. All right, switching gears. let's talk about that concludes the land portion. So let's switch over to retail. So every couple of years, I think it's good to just keep an eye on what's going on with online retail. And we talked about this a couple of years ago coming out of the pandemic, and there was a pretty big spike in activity for online retail, and it's worth revisiting here. So what you're looking at is on the left is the amount of e-commerce sales in billions, also in the blue on your chart there. And on the right side, and also in the green line, is showing the percentage of e-commerce to the overall retail market. So overall retail market's going to have hotels, restaurants, gas stations, everything. So we're at about 16% is where e-commerce is in perspective to the entire retail market. And we all knew this would happen. There's a big spike during the pandemic. We all sat at home and ordered more than we should have probably from our couches, and that has kind of settled down now, so that's gotten a little bit more normal. But what I find interesting on this is we've really kind of kept that same trajectory, that same growth pattern as we were pre-pandemic, dating all the way back to 2015. So again, an interesting thing to keep an eye on, but as we've gotten a couple years past the pandemic, I think it was worth kind of noting and showing you guys. Let's talk about our local market. Here in the Sioux Falls area, we'll start with vacancy rates. So overall, our vacancy rates are in a pretty good spot. We're at about 9% citywide. Nationally, 10.3% is where they're at. So we're doing a little bit better than the national market, which is good. And there is some thought in some of these national articles that they believe that the vacancy rates for retail will come down a little bit more here in 2025. And that's primarily driven to there's not going to likely be as much new construction coming online. So with less new square footage available, we may see some of that older, tired retail get taken up by some of these retailers. Be an interesting trend to watch. Open air retail centers, just a real quick note that's just kind of a fascinating number. So open air retail, think about these, outlet malls in Minneapolis and Omaha. That's what we're talking about with open air retail center at a 3.5% vacancy rate. They are doing very, very well. Let's look at our property sales. So $52 million in 2024, over 23 transactions. Pretty solid year for the city of Sioux Falls. Speaking of the city, they were one of the larger transactions. They bought the Sanford Wellness Center on the west side. Another transaction to note is Empire East, which would be kind of part of the Empire Mall area. So on the south side of Target there, a portion of that sold and exchanged hands as well. Let's look at retail expansion. I touched on this a little bit last year and just want to continue to kind of mention this. I think we really are looking for that next regional retail center. So you think Dolly Farms, you think Lake Lorraine, a lot of those spaces are pretty well filled up, and where is this next regional retail center going to be? And I think 85th and I-29 interchange, as we continue to make strides towards getting that to finally come to life, I think that could be a really interesting area to keep an eye on. Now, different but similar area is South Veterans Parkway. We all have driven on the road from Western Avenue to Cliff that goes really nowhere, but it's awesome. You can go like 120 and no one will know. So that's going to continue to get developed. Again, a little bit different because it's not a one four-corner intersection that could have retail on any side of it. This is going to really change that south side where there could be a lot of hot spots for retail. Now, this is a little further down the road. It's going to take time to get there. It's going to take time to get the road built, but this will be a really interesting trend to watch. All that said, there's a lot of potential here on the south side of Sioux Falls, and I think it's going to be interesting to see the city of T and Harrisburg and Sioux Falls come together as one big metro area. Let's look at our predictions. Well, the retail market is one of those that kind of gives mixed signals, right? So you guys can all find articles and say there's a bunch of store closures and it feels like it's a kind of a rough go, but you can also find a lot of articles that make you believe the retail sector is doing pretty good. And I think it really is overall doing pretty good. And one of those trends that we're seeing is restaurants nationally are winning again. Now, I know some of us have a favorite restaurant that closes locally and that sucks. But I think overall restaurants are winning again. and landlords are getting more and more comfortable signing long-term leases with restaurants. So that's an interesting trend. They got beat up pretty well during COVID. They're starting to make a pretty good comeback. Speaking of restaurants, must be getting close to time to eat or something. There's more QSRs, quick service restaurants, in neighboring communities. We're hitting this trend a lot here. You guys hear it throughout the presentations. Tea, they now have a Starbucks. I think soon to have a Taco John's. Not sure if that's open yet or not. Harrisburg now has a Dairy Queen and a Scooters. Jimmy John's is now open in Brandon. So a lot of these national chains are starting to look into these neighboring communities. That is a trend, I think, that's going to continue to happen for years to come. New construction, I think, is going to be down in the short term. For 25, I think it's going to be down. I think there's just, it's expensive right now to build. Interest rates are pretty high. I think we're going to just see a little bit of a pause on new construction. And so I think we'll see that down here for 2025. Vacancy rates, I think, will also go down, which will be a positive. However, the big factor that always can change the game is if we have any big vacancies announced for a particular retailer that is closing shop. But if all stays well, I do believe our vacancy rates will go down in 25. Let's look at where we're at on the real estate cycle. Well, I'm going to keep us in expansion, kind of all things considered. The retail market's doing pretty well, and I think we're going to continue to live in that world here in 2025. And with that, that concludes our retail presentation. I'll invite up Andy Anderson to present on the office market.
Thanks, Ed. Hello, I'm Andy Anderson, and I get to talk about the most affected sector since the pandemic. Yay. And that's the office market. Let's start off with some national news. The national office vacancy rate hit a record high of 20.9% in 2024. That represents a significant amount of vacancy. However, after several quarters of negative net absorption, we did fortunately see positive net absorption in 2024 in the national office market. What that means is more space is getting leased than vacated. Demand is really returning to pre-pandemic levels. The biggest contributor to this high vacancy rate are in these zombie buildings. These are large office buildings that have more than 50% vacancy in them. We're seeing this at a local level as well, but I'll touch on that a little bit more later in my presentation. One way to measure the health of the national office market is to look at commercial mortgage-backed securities. CMBS represents about 10 to 15% of the market and is typically in very large loans, between $30 and $50 million. However, this is still very indicative of what the national office market is looking like right now. And the CMBS special servicing rate hit a record high of 14.6%. Now that really tells you how borrowers' stress is right now. Let's shift gears and take a look at the local market. We have a total of 17.6 million square feet in our office market. 8.2 million of that is owner occupied. Now we've seen a shift over the last couple of years where there's been more speculative building taking place, and so now the tenant occupied space has outpaced the owner, sitting at 9.3 million square feet. Of that 9.3 million square feet, 1.1 million square feet is vacant. And our Sioux Falls vacancy rate is at 11.6%. We're typically much lower than the national vacancy rate, and this year has been no different. However, that gap is widening significantly, once again reiterating the stress we're seeing in the national office market. We had a total of 35 sales in Sioux Falls with $55 million in sales volume. You can see the last couple of years, the sales have really stabilized, even in a high interest rate environment. Buyers are still making decisions to move forward, and I expect we'll continue to see that throughout 2025 as well. A couple of examples. We sold 9 office condos to a local investor for $186 a square foot. We sold a former call center space to a medical user at a good price, $118 a square foot. However, these conversions are very expensive, so even though they bought it at a decent per square foot price, they did have to make a significant amount of investment to convert this to medical use. And the Lindcrest building was already set up for a medical type use, resulting in that price being at $291 a square foot. Now we break the office market up into two sectors. The downtown sector has 2.67 million square feet and is currently sitting at a healthy vacancy rate of 5.9%. We have over 100,000 square feet available for lease. And throughout 2025, with maybe some new announcements, I think this might go up just slightly. And Class A rental rates continue to go up, which is no surprise with construction being what it is. However, we've seen a shift in the office market. After the pandemic, some businesses downsized their need for square footage, and we saw a shift from moving to Class C space into Class A space, really pushing those owners of Class C to get a little bit more aggressive in their rental rates. And the suburban sector is everything excluding downtown. We have 6.67 million square feet in this sector, and the vacancy rate is double what the downtown vacancy rate is at 13.9%. Now, this is a big number, but we have over 900,000 square feet vacant. And similar to downtown, we're seeing the same pattern. Class A rental rates continue to tick up. However, Class C and some even Class B minus spaces are really getting more aggressive with their rates. And I think we'll continue to see those stabilize, if not go down just slightly. Now let's talk about that big number, that 1.1 million square feet that we have vacant in Sioux Falls. Of that, over 800,000 square feet is in blocks of space of 10,000 square feet or greater. That represents 75% of all of our vacancy. Now, if we were to pull that 800,000 out, the vacancy rate that we're currently sitting at, 11.6%, would drop to 3.1%. So that really represents that the Sioux Falls office market is pretty tight. So what do I do about these large blocks of vacancies? I think throughout 2025 and into 26, sellers really need to adjust their mindset on pricing. We have buyers for these properties. However, they need to come in at a really aggressive per square foot price to make it work. I mean, the construction, the renovations just cost such a significant amount of money that they just really need to be aggressive on their offers. So I think that we'll see that starting to take place throughout 2025. Some predictions. Again, we have demand for office space, and that's 10,000 square feet or less of office buildings. So I think we're only going to see our construction increase over the next year. And one trend we've been watching are the triple net expenses. Taxes and insurance continue to go up on an annual basis. But what's interesting is our triple net expenses are getting so high, they're now matching, if not exceeding, what Class C rental rates are starting at. So where does that put us on the real estate cycle? I really think it's the year of recovery for these call center spaces. Once again, we have buyers for them, whether it's retrofitting, converting, or potential land opportunities. I think we're going to see changes in those products this year. And again, with a demand in office space and limited supply, I think the office market is definitely in expansion throughout 2025. And with that, I'd like to bring up Rob.
All right. Well, thanks, Andy. You got two more to sit through here, so bear with us. I'm going to kick off this year's presentation by highlighting a few things nationally, compare it to our local market, and make a few predictions of where I think the industrial market is headed for 2025. Okay, so I want to address the lingering elephant in the room, and that is tariffs. Reggie talked about it in his presentation, but it's having a real effect on the psyche of various industries, particularly in manufacturing. Since the start of the year, there were 3 companies that were looking to grow in the Sioux Falls area and decided to pump the brakes, for lack of a better term, and wait for the dust to settle around all this tariff discussion. So instead of focusing on the pros and cons of tariffs within industry, I want to look at one metric that is a huge driver of activity or getting the sense of activity within manufacturing. and that's known as the Purchasing Managers Index, otherwise known as PMI. I want to bring your attention to that bold black horizontal line at 50. That's a PMI of 50. In other words, equilibrium. If it's above 50, it means that the US manufacturing segment is in expansion mode. If it's below 50, it's in contraction. You can look back to COVID in 2020, manufacturing came to nearly a screeching halt. And during that time, many of you may remember that supply chains broke down. And in order to backfill that need, all of a sudden there was this rampant increase in manufacturing for several years, all the way until about the end of 2022, where it crossed back over into a contracting market, which is where it's been the past 2 years. Now, we have 2 data points thus far in 2025 showing some positive signs of growth in the manufacturing sector. So all this tariff discussion, so far it's looking like manufacturing is going to do quite well in 2025. Okay, let's look at a few other indicators on a national level. How are things going nationally? Well, vacancy was at a 10-year high. Net absorption was the lowest it's been since 2010, in negative territory. New construction was down, and asking rents saw their largest decrease year over year at 1.3%. Again, the most since 2011. National was not looking the greatest this past year. So let's bring it a little bit closer to home and take a look at the Midwest. Well, you can see vacancy a little bit better in the Midwest. Absorption and construction, huge pullbacks on the construction side and the absorption side. The one positive was that asking rents increased by about 7.5% in the Midwest. So it begs the question, how are we doing in Sioux Falls? Well, vacancy's even less, just over 3.5%, pretty healthy. And then we saw increases across the board here locally in all those other categories. And I'm going to dig into that a little bit more as we transition over to the local market. Now, I always want to start off this part of my presentation by highlighting some of the sub-industries within our local market. And much like nationally, we have manufacturing, warehousing, distribution, transportation. But a large driver in our market are contractor shops. This is something that national does not track. And I'll talk about those in just a second here. Okay, let's look at our overall industrial universe. Most people think of our industrial market as Sioux Falls proper. You can see on the map here that over the years, it's expanded out into a lot of the surrounding communities. Something that you don't see a whole lot of in some of the other sectors tracking the building out in these areas. 2024, we had about a 3% increase in the overall market, up to about 32.5 million square feet. So what made up some of that increase? Well, B&B Molding out in Brandon was leasing some space. They decided they wanted to owner-occupy a building. So they built a new facility over in the Rovang Industrial Park out in Brandon. Head south to the Harrisburg exit. Ace Ready Mix built their new asphalt plant. You can't miss that thing when you're driving by on I-29, sticking up in the air. And on the north side of Harrisburg, Builders First Source. I know many of you are familiar with Schoenemann's, family-operated company for a very long time here, was acquired by Builders First Source, and they decided to build an addition on their property right around 100,000 square feet. That was on the manufacturing side, a few examples of manufacturing. On the warehouse distribution side of things, Owens & Minor partnered with Avera and built a 325,000 square foot warehouse up in Foundation Park. Overhead Door, local family-owned company, are building a new building right along I-29 on the west side of town. And Johnson Hardwood put up about a 40,000 square footer just up north of the new McGuire Iron manufacturing facility up along I-90. On the transportation side of things, Old Dominion and FedEx made a few big moves. These are cross-dock terminals here in town, and they built collectively right around 100,000 square feet of space to keep up with the growing demand of transportation within our region. Okay, those are a few examples. How'd new construction fare overall? 2024, third highest that we've seen in the history of our market. Just over 1 million square feet was built this past year. So how are we doing on the absorption side? Pretty good. Following the same trend lines, about 840,000 square feet got absorbed this past year. Now, I would like to note that I highlighted nationally that there's a ton of negative absorption on a national level. Sioux Falls, in the 20 years that we've been tracking this information, we've never had negative absorption in our market. It's always been just a slow and steady and strong market here locally. And it's no wonder why we continue to see our historic run of being well below the national average, just above 3.5%. Now, I do think 2024 saw a peak in vacancy rates, a couple years of just run up. There's a lot of space out there that is still available today, and so I think these rates will start to come down both nationally and locally. Switching gears and taking a look at industrial property sales. 2024, as you can see, second highest year when it came to total dollars being spent on industrial property, 113 million, which equated to 73 total transactions, the highest we've ever seen in this sector of the market. Now, this is proof of the growing demand for industrial property that is available for sale within our market. And it's part of the reason why I wanted to create this next slide, to get a better understanding of the price per square foot that companies are paying for industrial property. If we rewind back 10 years ago, 2014, the bulk of industrial properties were selling for under $75 a square foot. Fast forward 10 years to 2024, we've seen a huge shift. $76 to $125 a square foot led the way, and several more even north of that. I mean, we're getting close to what it costs to build a brand new industrial building in Sioux Falls. So pretty interesting data, and we'll continue to track this throughout the next year. Okay, switching gears, taking a look at the leasing side of things. Just wanted to highlight the price per square foot that people are asking throughout our area. And you can see Class B and Class C space has a tighter range than what we see in the Class A space. And that's predominantly because Class A space has a diverse set of drivers in that sector of the market. And those include the inflationary cost of construction, more flex type uses, or smaller contractor shops. The $10 to $12 a square foot space is predominantly new construction of contractor shops and flex spaces below 5,000 square feet. So let's take a look at my predictions. New construction. Braden talked about all these industrial land sales that were taking place this past year. We'll see some of those sales break ground this year. CJ Foods is going to build an enormous facility along with a few others that closed in Q4 of last year. So we're going to see new construction go up in 2025. As for vacancy rates, I had mentioned on my previous slide there that we're going to see a turnaround, and vacancy rates will start to go down as some of the existing space gets backfilled. Lease rates will stabilize. We've just had such a aggressive run up these past several years, in lease rates, and I think those will remain steady. As for sales transactions, last year was the highest that we've ever seen. There continues to be demand out there in the market, and so I think we'll see another really strong year when it comes to transactions. Okay, for my real estate cycle, industrial is a little unique. For a couple years now, it's kind of had this teeter-tottering effect between expansion and hyper supply. And so I put industrial right at the peak. We have 3 bullet points in the expansion column and 2 bullet points in the hyper supply column. And again, we'll report at our mid-year report. We'll report back on this and see where we're at that point in time. So with that, I'd like to bring up Alex Soundy to present on the multifamily market.
All right, thanks, Rob. As Rob said, my name is Alex Soundy, and I'll present on the multifamily market today. Let's dive into it. We'll start by taking a look at the national market, starting with sales volumes in 2024. There was $146 billion worth of sales in the national multifamily market in 24, up roughly 22% from those numbers in 2023. Now, the year started off to a slow start, but with solid sales numbers in the third and fourth quarter, the back half of 2024 finished with nearly $100 billion in sales in the multifamily market. Look for investors to continue to try to build off this momentum going into 2025. But what's keeping the multifamily market from seeing those huge numbers of sales we saw in 2021 and 2022? Well, let's look at the cap rate spread. This chart shows the multifamily cap rate spread dating back to 2001. A cap rate spread is essentially the difference between a 10-year treasury rate and a market cap rate at any given time. So the black bars there represent the 10-year treasury yield each quarter dating back to 2001, with that gold portion showing the cap rate spread at that time as well. So in 2024, multifamily cap rates remain relatively stable at about 5.6 to 5.7% nationally, whereas the 10-year treasury was a little more volatile, bouncing between about 4.1 and 4.7% for most of the year. There was a slight pullback into the mid-3s in the third quarter, but that was very short-lived before jumping back into the mid-4s. So that being said, throughout 2024, the cap rate spread for multifamily was mostly 100 to 160 basis points, which is extremely compressed when you compare it to the 310 basis point average dating back to 2001. Think of it this way: the tighter the spread, the tighter the deal. So investors sat on the sideline in 2024 waiting for that spread to widen. And there's 2 ways that would have happened. Cap rates would have went up, or interest rates and treasuries would have pulled down. Let's look at something that's affecting multifamily valuations, what I like to call NOI erosion. NOI stands for net operating income. Nick explained it earlier, but it's essentially gross income minus operating expenses. You get your net operating income. That's before any debt is paid. Now, there's 2 things that really affect NOI: income and expenses. So post-COVID, multifamily rents rode that inflation wave, and we saw record year-over-year growth in multifamily rents. But not a lot of people think about the expense side of that, as that lagged a little bit behind. But insurance, property taxes, labor, materials, utilities have all surged the past few years, in some cases completely wiping out the gains that a lot of these properties have seen post-COVID, which is directly affecting the values on these properties. Let's look at some things that multifamily investors really like to see and what has investors looking specifically at the multifamily asset class. This graph compares the average multifamily rent compared to the average mortgage payment monthly. When I'm talking mortgage payment, I'm talking just principal and interest payments on the median priced home in America. So that black line going across the center is essentially the equilibrium when the average rent and the average mortgage payment are the same. When those black bars are below that black line, the average mortgage was actually cheaper than the average rent. When those black bars exceed that black line, that is when the average mortgage exceeded the average rent payment, monthly rent payment. So as you can see, for the better part of the last decade, the cost of home ownership has completely outpaced the cost of multifamily rent. This is what investors look at. As more and more people are getting outpriced of the home market, it's creating more and more of a demand for multifamily housing. And investors look at this as a trend that's not changing, unfortunately, having them very interested in investing in multifamily because they believe the demand is going to be there long term. Now let's look at something that could specifically drive sales in the multifamily sector in 2025. There's a looming tranche of loans or of multifamily loans coming due in the back half of 2025. Now there was a similar tranche that hit in 2023 that had little impact on driving multifamily sales. What's different this year? Well, with a special servicing rate for multifamily loans of 7.37%, which is the highest it's been since 2015, we're in different economic times. Lenders are less likely to blend and extend these troubled loans, causing a lot of borrowers to maybe be forced to sell this year. Let's look at a quick case study of what a refi could look like this year. Rewind 5 years, the third quarter of 2020. We have an investor looking to buy a $10 million apartment at a 5.25% cap rate, which is a fair market cap rate for a Class A apartment building at that time. Now they're trying to leverage as much as they can, looking for an 80% loan to value, seeking an $8 million loan. They're looking for a 5-year fixed term to get the most competitive interest rate they can get. Reaching out to several banks, they get the below term sheet. 3.5% on a 30-year amortization with a 1.2 debt service coverage ratio requirement by the lender. Annual debt service for this would be just above $431,000. Meeting the lender's requirement, this deal pencils. Fast forward 5 years, this property's seen 4% year over year growth in NOI. 2025 comes, their loan's about to mature in the back half of the year. They're going to have just under $7.2 million of principal balance remaining on this mortgage. Their NOI has grown to $614,000, which is a 17% growth from where it was when they bought the property in 2020. That's that 4% compounding year over year. Knowing their refi is coming up, they reach out to several lenders to get the most competitive term sheet. 7.5% interest rate, still able to get a 30-year amortization, and the lender's still requiring that 1.2 DSCR requirement. The maximum loan they're able to get for this property that's grown its rents or NOI 17% in 5 years is $6.1 million. What does that mean? They need to bring $1,075,000 to the table to pay off their original mortgage. Now, there's investors out there that will just readjust their capital stacks, pull equity, pay this off, move forward. But there's a handful, I shouldn't say a handful, there's a lot of investors out there that aren't going to be able to do that and are going to be forced to sell their asset. And there's no shortage of investors waiting on the sideline for this exact scenario to take place. Let's look at the local market. In 2024, there was 1,224 multifamily units permitted, which was down about 36% from the 1,930 units permitted in 2023, and down 67% from the just over 3,300 units we saw permitted in 2022. Now this comes as no surprise, as developers dealt with high construction costs and high interest rates all year. A lot of them put their pencils down as the projects didn't make sense. Now let's look at the total residential units permitted in Sioux Falls. So this is taking the multifamily units we just looked at. Now we're adding in single family homes and townhomes. We're trying to get the full picture of residential units permitted year over year. From 2022 and 2023, 76 and 71% of residential permits were for multifamily. We saw that drop in 2024 to 58%. With those pullbacks in multifamily units permitted, made sense, we saw a drop there. That puts us exactly in line with where we were in 2020 and 2021, before we saw that surge of multifamily activity in 22 and 23. Watch for that number to potentially even pull back further in 2025, maybe to the lower 50s, as developers are still going to face the same challenges that they faced in 2024. I'll touch on that a little bit later. Now let's look at vacancy rates for Sioux Falls. Sioux Falls ended 2024 with a 10.14% vacancy rate for conventional units. That's the first time we've seen a double-digit vacancy rate for multifamily, dating back to 2018. and has us above the national average to N24, which was 6.7% nationally. Now, one thing I'd like to note is when the South Dakota Multi-Housing Association puts together their vacancy report, they do not factor in newly constructed units that are going through their initial lease-up phase until they've achieved an 85% occupancy or until they've had their certificate of occupancy for at least 1 year. So when we factor those new construction units that are going through their lease-up, which are technically vacant units, we actually believe the true vacancy rate in Sioux Falls to be closer to 14.33% for multifamily. Let's look at rent growth in Sioux Falls. From 2020 through 2023, we saw about a 40 to 50% growth in multifamily rents. In 2024, we saw that flatline as property managers focus more on tenant retention with the rising vacancy rate. This isn't the full story though. In fact, 20% of apartments in 2024 offered some sort of rent concession, whether that was 1 month free rent, 2 months, or in some cases up to 3 months of free rent. That had an effective negative rental rate decrease in Sioux Falls, meaning we actually saw the net effective average rents in Sioux Falls go down in 2024. So how does Sioux Falls compare to our peer cities? Well, much like Sioux Falls, Rapid City saw a huge surge in multifamily development the past few years. But unlike Sioux Falls, Rapid City really struggled to absorb these new units, with the vacancy rate coming in at 16.4%. Rochester and Des Moines followed at 9.4 and 8.8%, followed by Fargo at 7.7, and Lincoln, Nebraska coming in with a low vacancy rate of 7%. Now, this should come at no surprise, as there's no shortage of people wanting to move to Lincoln, Nebraska right now to become a resident before Nebraska wins a national championship in 2025. Go Big Red. Let's look at multifamily sales. 2024, we saw 21 sales transactions for a total of $87 million, which was down slightly from the $92 million of sales we saw in 2023. Now, one interesting fact, of those 21 transactions, there was only 7 transactions that were over $1 million. And 3 of those transactions were all cash purchases from out-of-state REITs that were a total of $60 million. So if we pull those 3 all-cash REIT purchases out, we would have only saw $27 million worth of sales volume over 18 transactions in 24. This really highlights the financing challenges that investors faced when trying to put together multifamily acquisitions last year. Let's look at a few of those transactions. Villas at Canyon Creek. This property is located in southeast Sioux Falls. 260 units sold for $32 million this past July, which came in at about $123,000 per unit. That was one of those all-cash purchases from an out-of-state REIT. That same REIT bought the Boulder Creek townhomes located on the west side of Sioux Falls for $16.5 million this past July as well, at that same price point of $123,000 a unit. One thing I'd like to note about those 2 transactions is that $123,000 per unit price point is well below the repurpose cost for both of these properties. This should be a good long-term hold for this investor. Summit Apartments, located west of downtown Sioux Falls. This 16-unit apartment sold for $2 million this past August. Now, $125,000 a unit for a nearly 90-year-old property doesn't look well on paper, but that's not the full picture. This is a registered historic property with the city of Sioux Falls, larger units, high-end finishes, and it truly drives premium rents, making it not a great apple-to-apple comparison on a per-unit standpoint. I think this would be a good property for this investor moving forward. Let's look at predictions going into 2025. I predict interest rates are going to remain stable. I don't think we're going to see a ton of movement. This will put upward pressure on multifamily cap rates. I predict that the 10-year Treasury will remain between 4.25 and 4.75% throughout 2025. Now, one thing to watch, if that 10-year Treasury rate drops below 4%, I think we will see a surge of multifamily activity. I predict that we'll have double-digit vacancy rates in Sioux Falls throughout 2025. I wouldn't be surprised if we actually tick up a little more when that mid-year report comes out. Now, this is not me sounding an alarm. I do not think that Sioux Falls is in trouble long-term. We simply just overbuilt in 2022 and 2023, and we're absorbing a lot of new units into our market, which in the long term are needed, but we have to go through a little pain as we absorb those. I wouldn't be surprised if we're back into the single digits by early 26. And this is probably my boldest prediction here. Multifamily building permits will be less than 1,200 units in 2025. Now, why is this bold? Well, we already permitted 200 units in January. But I really do feel that developers are going to be facing those same challenges that they faced last year. High interest rates, high construction cost, and now we add in double-digit vacancy and stagnant rental rate growth. It doesn't look great. So long-term, I think we'll get back to our normal pace, but it's just going to be a difficult year in 2025 for new multifamily development. So where does that put Sioux Falls on the real estate cycle for multifamily? Well, with increasing vacancy rates and low rental rate growth, I have Sioux Falls at the end of hyper supply. Now, one thing I'd like to add is that for the long term, I think Sioux Falls is one of the best markets to invest in multifamily. We have a really good, strong local economy, and as Sioux Falls grows, our vacancy rates will pull back, our rental rates will grow, and our developers will continue to build. Long term, I'm very bullish on the Sioux Falls multifamily market. And that concludes my presentation on multifamily, and I'd like to bring up Reg to close us out.
Thank you all again for being here. It truly is an honor to host you, the business community. I hope you found the information timely, trusted, and accurate. We threw 140 slides at you in an hour and 20 minutes. So before I get to the swag, I do want to say a quick thank you to our team, Summer Hoffman, Sarah Wolfswinkel, and Ellen Jesperson behind the curtain here, and also to Reagan for her help, Reagan Riley with her help this year. If you want the slide deck, the QR code is in your program. It's also up there. And now you can join us on stage for a happy hour. Let us buy you your favorite beverage. But before we do have, back by popular demand, a Jackrabbit inspired 605 hat. Jackrabbit Nation. Anybody out there? Yote Nation? Sodak rope hat, okay? We got one for everybody. So, and we got a Sioux Falls beanie as well. So join us on stage. Thank you very much for your time.